It's a question that I get from some of my friends. My girlfriend once, she'd inherited like 50 grand and she called me up and she said, Susie, I just got all this money. When should I put in the stock market? And I said, oh, dear Diane, if I knew that, I'd be rich. So I explained to her that all we know about the market is that it's going to go up and down and up and down. And if we knew when the price was going to be the lowest, well, that's when I'd tell her to put in all of her money, but I don't know when the price is going to be the lowest. So I explained this to her, and she basically said to me, she said, so what you're saying is that I should invest the same amount of money every month on, let's say, the 15th of the month. And if I put in $5,000 a month for every month for the next 10 months, I'm not going to call you and yell at you because I put all my money in when the market was high. And that's exactly it. It's this philosophy that says, it's this type of way of getting money into the market that says you don't know when the price is going to be the lowest. So just invest the same amount of money at regular intervals. So that's the key to what we call dollar cost averaging. So that's what she did, and we're still friends. So dollar cost averaging. You want to do what? Test question. You want to invest the same amount of money at regular intervals. Same amount of money at regular intervals. So it could be monthly or weekly or whatever it is. This has nothing to do with getting the same number of shares every month. Has nothing to do with that. It says invest the same amount of money. All we know is that the price is going to change. So when the price goes up and up and up and over and down and up and up and up and down and over, you're going to end up by following dollar cost averaging. You will have an average cost per share that is less than the average price that you paid. That is less than the average price. And it doesn't sound like a big deal, but let me show you how it works. So within the PDF portion of the course, we have a table that gives us an example. And it says that we are going to invest $100 a month for 5 months. So there's 2 formulas in here. There's the formula for average cost. This is generally a math question. And then there's the formula for average price. So if you're investing $500 a month, $100 a month, I should say, for 5 months, how much did it cost you? $500. And then you take the $500 and you divide it by how many shares were you able to purchase. So if you look at the PDF, it tells you how many shares you were able to purchase. Every month you were able to purchase a different amount of shares. These are shares of a mutual fund. There are full and fractional shares. You were able to purchase a total of, once you add all that up, 75 shares. So the formula for average cost is what did it cost you divided by how many shares were you able to purchase. So you have your calculator, $500 divided by 75 shares gives us an average cost per share of $6.67. So that's average cost. Average price. Oh, remember back to 2nd grade math. I'm telling you, I can't stress enough. The math you learned back in school, it's relevant, but it was never relevant until today. So you have all of these different prices. So $5, $8, $10, $8, and $5. You have to take the sum of the prices. Sum of the prices. And then we're going to divide it by the number of investment intervals. So anytime you want to figure out the average of a range of numbers, the denominator is how many different prices were there. So 1, 2, 3, 4, 5. And I know the $5 appeared more than once, but you count each of those occurrences separately. So when we add the share prices up, we get $36. That's the sum of the prices. So $36 divided by the 5 investment intervals gives us an average price per share of $7.20. And remember, the whole point of dollar cost averaging was that when the price goes up, you end up with an average cost per share, that's the $6.67, that is less than the average price you paid per share. Yes, it works. The test question might have been, what is the difference between the average cost per share and the average price per share? So 53 cents, it's a subtraction question, is the difference. I expect definitely one question on dollar cost averaging. If your client has a desire for a capital goal within a specific time period, the shorter the time period, the more conservative their investment must be. So, for example, your client needs to have a $50,000 down payment for a house that they plan on purchasing in 5 years. Maybe putting the money in a savings account is the best idea for the client. A certificate of deposit, a bank CD would be okay as well. Do not put that 50 grand in the stock market. That is too much risk for a short time horizon for something like that they need the money in 5 years. The test wants you to feel comfortable with how are certain items taxed. Certain things are taxable as ordinary income, such as income received from wages, salary, and self-employment. Also considered to be ordinary income is income received from annuities, interest earned on most bonds. Alimony is taxable as ordinary income, as well as retirement plan earnings. So alimony is taxable as ordinary income. For most people, ordinary income constitutes the largest part of their total income for the year. Ordinary income is subject to progressive tax rates. That means that the more that you earned, the higher your tax rate. Some tax rates, like income tax rates, are progressive. Sales taxes, think about what the sales tax rate is where you live. I know where I live, it's 9.1%. Sales taxes are what we call a regressive rate. They're the same for everybody. Regressive rates hurt low-income earners more than a high-income earner because they represent a larger portion of that person's wages. So income tax rates are progressive. The test would like you to know that inheritance, gifts, and child support are not taxable as ordinary income. They're actually not taxable at all. If you receive an inheritance, it is not taxable to you, neither is a gift, and child support is not taxable. So those are definitely on the test. Tax due date. Your individual tax return is due on April 15th. That's your 1040. The test would like you to know, when is a corporation's tax due date? I bet you didn't know this one. March 15th. Corporation's tax due date is March 15th. Trusts and estates pay their taxes on the Form 1041. I have previously mentioned that. Estate tax returns are due 9 months after a person's death. The estate taxes themselves are paid out of the estate's checking account. Cost basis. Cost basis, very oftentimes on the test, is simply referred to as basis. So cost basis is how much money in that investment, how much money has already been taxed. Already been taxed. For example, in a qualified retirement plan, what's your cost basis? 0. None of the money in there has already been taxed. Where if you're buying open-end mutual fund shares, what you pay in is in after-tax dollars. So that's your cost basis. If you automatically reinvest dividends and capital gains, that increases your cost basis. It's important to understand basis so that we can make sure that we pay taxes on a long-term or short-term capital gain, the correct amount of gain, that we have the ability to figure out how much of the gain is actually taxable. If you have a test question about a non-qualified annuity, a non-qualified annuity is funded with after-tax dollars. We already talked about if you take out a partial withdrawal, it's taxed LIFO. Last in, first out. Earnings come out first. Taxable at ordinary income rates, plus you might even have a 10% early withdrawal penalty. There's 2 potential questions here as far as you might be gifted securities, or you might inherit them. So I'll tell 2 stories. So we have Uncle Bob. And Uncle Bob bought some shares of GM way back in 1992 at $20 a share. And let's say that today, GM is at 32. Let's just pretend. Uncle Bob is still alive, and he decides that he is going to gift to you these shares of GM. When you are gifted securities, you will assume the original cost basis and holding period. Now, Uncle Bob, if he's going to gift you something, he has to be aware of there is a gift tax exclusion amount. And anytime you give a gift that's in excess of the current year's gift tax exclusion, the person giving the gift owes gift taxes. If you receive a gift, you're just, yay, you don't owe any taxes when you receive a gift of securities. Gifts are free to the recipient. So, what's your cost basis? Uncle Bob gifted you these shares. Your cost basis is $20 a share. And if you decide to sell them, let's say a year from now, you decide to sell these shares that you inherited today. So 1 year later, you sell the shares at 35. The question is, what's your cost basis? $20 a share. How much do you owe taxes on? $15 a share. So you sold them at 35. This is your basis because you assume the original cost basis. And what is this? Long-term or short-term capital gain? It's long-term because it's assumed that you bought them in 1992. So long-term capital gain. If it's a short-term capital gain, it's taxable at ordinary income rates. Long-term capital gains, generally speaking, have lower tax rates than your ordinary income rate. So that's what would happen if you were gifted the securities. But let's say that this time, Uncle Bob has passed away and he left you these securities in his will. So you inherited the securities. So if you inherit the securities, what happens as far as your cost basis is different. So it's still the same story that Uncle Bob bought these shares of GM in 1992 at $20 a share. He died, let's say, today when GM was at $32 a share. If you inherit securities, you inherit them at their current market value. So it's a stepped up or down as the case may be, but stepped up in this case. You inherit them at their current market value. So this becomes this $32. This is your cost basis. So your cost basis is what they are at as of the date of Uncle Bob's death. So he died today. They're valued at $32 today. 1 year later, you sell the shares at $35 a share. The question is, how much do you owe taxes on? $3 a share. You inherited them at their current market value, $32 a share. You sell them a year later at $35 a share. Something that's very important. You pay taxes on an inherited securities always at long-term capital gains rates. This is one of the nicest things the IRS has ever done. It doesn't matter that really you only had them for a year, and that's really short term. It doesn't matter. It doesn't matter if you had them for 6 months or 9 months or 10 years. When you have a gain on inherited securities, it is taxable at long-term capital gains rates. Thank you, IRS. And partially that has to do with the fact that Uncle Bob's estate potentially has paid taxes already on some of this amount. So, long-term capital gains rates on inherited securities. We know if your client has a limited partnership with a flow-through of a passive loss, that can only be written off against passive income. It cannot be written off against ordinary income. Which reminds me of a great story. I had a student tell me this story, and I thought it was really sweet of him to be willing to share himself in this way. He didn't tell me the dollar amount, so I'm going to make those up. But here's the story. He said he was losing his shirt in the market. He had all of these capital losses. So let's say he has $40,000 in capital losses. He had some capital gains. Let's say he has $5,000 in capital gains. But he just kept losing in the stock market, and he thought to himself, heck, I'll just write it all off against my ordinary income. Huh? He said his accountant and his wife almost killed him. So there's this idea, when you have capital gains and capital losses, you have to look at them and net them together. So capital gains, capital losses, we're left with a capital loss of $35,000. And then what my student learned shortly after is that in any given year, the most that you are allowed to write off of your capital losses against your ordinary income is $3,000. That's all he was allowed to write off. So he had this huge carry forward. So you're allowed to carry forward this loss, for as long as it takes. Let's say that he decided he would never buy another security again for the rest of his life. How much could he write off every year from now until this was all taken up? Only $3,000 a year. So that's it's like legalized gambling. If you think about it, you might as well try to win in the stock market and lose at most $3,000 once you've netted it against your gains, because you can always write that off. So go play, right? Go gamble. So it is a form of legalized gambling, isn't it? Something else that is important to notice, what if here in this next year, let's say, that he decided to play in the stock market again, and he had gains the next year of $30,000. He would net his loss against his gain. That leaves him with a $2,000 loss. Could he write this all off against his ordinary income in the next year? Yes, he certainly could. So that concept is really important for your clients, and obviously not everybody knows about it. So make sure you remind them of that. The AMT tax. Have you heard of that? I'm sure you have by now. The alternative minimum tax was originally designed to prevent people with very high incomes from using special tax benefits, write-offs, to pay little or no tax. When the AMT was originally created, it was designed to catch a couple hundred families that weren't paying their fair share in taxes. That's really all that it was designed to affect. But the main problem with the AMT tax is that since it was created, it's never been adjusted for inflation. So today it ensnares millions of taxpayers, of which it was not designed to originally ensnare. So it's designed to make sure that everybody pays their fair share. And generally, that's all you need to know as far as a test question goes. I don't know if they'll ever fix the AMT tax. It's one of those things that always tends to get pushed off and pushed off and pushed off and pushed off. So what happens really when you become subject to the AMT tax is you lose the ability to write off certain items. So if you have two high income, they're married, they have lots of kids, they have two homes, all of a sudden they end up losing their deductions for part of their children, and their second home interest deduction goes away, and there's certain things that they lose, the deductions that they lose, and then they end up owing more in tax than what they would have thought that they were going to originally have to pay. So originally introduced in 1970 and designed to trap 155 high-income families who had no tax liability. It affects millions of taxpayers these days. Estate and gift taxes. I said this previously, that the test is not concerned so much about what's the exclusion amount. Because what happens is that the exclusions change. So current exclusions, estate tax exclusion, 5 million, gift tax exclusion, 13,000 per person. And it might be different the year that you're taking your test, so make sure that you read the PDF. I still mention those limits because, maybe you might have it on the test, but I highly doubt it because the people that write the test, they don't want to update the questions every year. So instead, they want to ask questions like, you give a $15,000 gift to someone, which is in excess of the current year's gift tax exclusion of $13,000. Who owes the gift tax is the question. The person giving the gift. The person giving the gift owes the gift tax on the $2,000 that's in excess of the current year's exclusion. And they gave you the exclusion amount right in the question. Same thing with estate tax exclusion. So it's the exclusion that's the not taxable portion. It's any dollar amount that's above the exclusion amount that is subject to estate taxes. When you have an estate, there is sometimes a question as to what prices do we put on something like, let's say, the house. So the property within the estate is assessed at its fair market value. So the property in the estate is assessed at its fair market value, and that is the price at which the property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or to sell, and both having reasonable knowledge of relevant facts. If I was to write you a check for $13,000, is that taxable to you? Nope. Would you like me to? I'd be writing a lot of checks, wouldn't I? If I was to write you a check for $15,000, is that taxable to you? No, but I, the person giving the gift, would owe gift taxes on the $2,000. So the gift tax exclusion says that you can gift as many people. When you pass your test, you can gift me $13,000. You could. You can gift as many people as you like $13,000, and you will not incur a gift tax bill. If it's more than $13,000, then of course you would. Gift taxes, however, do not apply to gifts between spouses. They do not apply to gifts made to charities. Gift taxes do not apply to gifts used to pay tuition or medical expenses, and they do not apply to gifts made to political organizations. Retirement plans. We're going to talk about retirement plans. If I discuss a limit, then I would know the limit, but I'm not going to discuss all of the different retirement plan contribution limits. You can reference them on the current year's PDF for tax facts, the contribution limit handout. But it's not a limit-heavy test, so unless I mention it, I'm not worried about you knowing the limit. We're going to start off with IRAs. Individual retirement accounts, IRA. So, test question. Can you have a 401k where you work and an IRA? Yes, of course you can. An IRA is separate from what you have at work. So there's two types of IRAs that you're going to need to feel comfortable with. There's the traditional IRA, and there's the Roth. Usually my students are fairly comfortable with the differences between these two already, but we're going to discuss them anyway. So the current contribution limit into an IRA. So you could put it into one or the other, or I suppose you could split it, but people don't normally do that. They usually fund one or the other. Is $5,000 plus an additional $1,000 if you are age 50 or older. So 50 or older. So if you were age 50 or older, you could put $6,000 into either a traditional or a Roth. A Roth IRA is always funded with after-tax dollars. Always funded with after-tax dollars. Always. Not everybody can fund a Roth IRA. So there's an income phase out. So consult the current year's PDF for exactly where it phases out. If somebody earns $75,000, they can still fund a Roth. $120,000 married filing jointly, they can still fund a Roth. After-tax dollars go into a Roth, but not your wealthy clients. Your wealthy clients are generally going to earn too much to fund a Roth. Why are Roths so incredibly popular? The earnings are federally income tax free. That's a great thing. How do we get the earnings to be federally income tax free? We have to make sure that when we take out the earnings, they meet the definition of what is called a qualified distribution. There's a couple of things that go into having it be a qualified distribution. The Roth account must have been open at least 5 years. So that doesn't mean that you funded it for 5 years. It means it's been open for at least 5 years. You may have only funded it once. And it's true that some years your income might be low enough that you can fund it, and some years you might not be able to fund it, but then the next year you can do it again. So that's possible. And in order for the distribution to be qualified, thus the earnings to be federally income tax free, the money must be paid out on or after 59 and a half. So paid out on or after 59 and a half. Something to note, however, when you have a Roth IRA, you're paying into it in after-tax dollars. So that's your cost basis. That's your money. If you need your $5,000 out next year, you can take your $5,000 out next year. There's no ordinary income taxes that are owed. There's no penalty because the $5,000 that you put in this year was in after-tax dollars. It's kind of like a glorified savings account. Now, if you put in $5,000 this year and you take out $5,000 next year, there's really not much in there to earn anything. But the money you put in is your money to take out whenever you want. In order to have it be a qualified distribution, thus the earnings to have them be federally income tax free, the account must have been open for a minimum of 5 years and it must be paid out on or after 59 and a half. So if neither of those things, one of those things is not true, then the earnings would be taxable at ordinary income rates. And if it's paid out before 59 and a half, there's a 10% penalty. It's a retirement account after all. So Roth IRAs, one of the things people sometimes say as far as Roth IRAs go is that you're getting the tax break later because the earnings are federally income tax free. Whereas generally speaking, if you do a traditional IRA, you're getting the tax break now. That's true, sort of. Let's see. Let's talk about this. The contributions into a traditional IRA may or may not be tax deductible. The contributions into a traditional IRA may or may not be tax deductible. So, in any situation, when you fund a traditional IRA, you're putting in your after-tax dollars. How do we get the contribution to be in pre-tax dollars is a matter of, are we allowed a write-off when we do our taxes for the amount of the contribution or not? Is it tax deductible on our personal income tax return or not? So if it is tax deductible, then we end up with pre-tax dollars in our traditional IRA. Thus, we would have a cost basis of 0. If it is a tax-deductible contribution. If it's not a tax-deductible contribution, then it's funded with after-tax dollars, and the money that we put in represents our cost basis. So let's discuss how do we determine whether or not the traditional IRA money goes in is in pre-tax or after-tax dollars. If 1 and 2, then no tax deduction allowed, which is another way of saying that it's funded with after-tax dollars, but I'll explain. If your client makes too much, that's kind of vague. I'll show you. And they are an active participant in an employer-sponsored plan where they work. So they have a qualified plan where they work, and they earn too much. It might be that they earn too much to fund a Roth IRA, so here they are wanting to put their $5,000 somewhere, or maybe they're 50 and they got $6,000 to put somewhere. So if they earned $200,000 last year and they have a qualified plan where they work, they can't fund a Roth, they would fund their traditional IRA with after-tax dollars, meaning that this is not tax deductible. No tax deduction is allowed. Another way of saying that is that it is funded with after-tax dollars. So your client earned $250,000 last year. They do not have a qualified plan where they work. They cannot fund a Roth because they earned too much. Can they fund a traditional IRA? Yes. Anyone with earned income can fund a traditional IRA in pre-tax or after-tax dollars. Pre-tax dollars. Yes, they earned too much, but they didn't have a qualified plan where they worked. So the rule says if 1 and 2, then it's funded with after-tax dollars. So in that situation, it was funded with pre-tax dollars. Let's say your client is a kindergarten teacher. She earned $40,000 last year. She has a qualified plan where she works. Can she fund a traditional IRA? Yes. Pre-tax or after-tax dollars? pre-tax dollars, meaning she does get a tax deduction when she does her taxes for the amount she contributed. $40,000 is not too much. It is not. So they'll be as obvious as they can about someone makes a lot or someone doesn't, $40,000 is probably the highest paid teacher you'll ever meet, actually. So not that much money. There's another thing about traditional versus Roth IRAs that I just thought about that I need to make sure that we remember. So traditional IRA, Roth IRA. Which one do you have to stop contributing to and begin your distributions by April 1st of the year after you turn 70 and a half? The 70 and a half rule applies only on the traditional IRA. You can have a Roth. You do not have to begin your distributions. There's no 70 and a half rule. That's another reason why Roths are incredibly popular. People don't like to be told when they have to start taking out their retirement money. So this is a big rule. If you don't start taking your distributions, it's called your required minimum distribution, no later than April 1st of the year after you turn 70 and a half. If you didn't do it, your penalty is 50%. 50% of your required minimum distribution goes to the IRS in the form of a penalty. Can you believe that? That's crazy. Something else that I need to point out when you have a traditional IRA, when you take money out, if you're taking out any earnings or anything that has not yet already been taxed, the taxes that are owed, it is taxable at ordinary income rates. Ordinary income rates. If you take out money under 59 and a half, there's also a 10% early withdrawal penalty. They do waive the penalty on all types of qualified plans for things like higher educational expenses, death, disability, divorce, first-time homebuyer expenses up to $10,000, pay for qualified higher educational expenses. That is also going to be something that they'll waive that 10% penalty for. So Roths do not have the 70 and a half rule, but the traditional IRA, it does. Can you overfund an IRA? I mean, you could, but you don't want to, because there's a 6% excise tax on the amount that you overfunded the IRA. So every year you can only put up to whatever the current limit for that year is. You do have to have earned income. It is the limit of the year or earned income, whichever is less. So if your earned income for the year was only $2,000, that would be the most that you could put into your IRA this year. A lot of IRAs are in mutual fund accounts, but they could be in self-directed brokerage accounts. You cannot use your IRA to purchase collectibles such as art, antiques, gems, stamps, and coins. Municipal bonds are probably not suitable for your IRA either due to the lower yield because of the tax-free interest income. Upon the death of an IRA owner, their surviving spouse can delay distributions until they reach age 70 and a half by electing to treat the inherited IRA as their own IRA. Or they have the choice of electing to receive distributions based upon their joint life expectancy with someone else, like a child. That would help to stretch out those payments. We discussed Roth IRAs. We know how those work. Rollover IRAs. Generally speaking, a rollover IRA is going to be from a traditional IRA into a Roth. Anybody can do it. It's like the back door into a Roth, which kind of makes me laugh because Roths do have income limits. So not everybody can fund a Roth. But anyone that's under 70 and a half with earned income can fund a traditional IRA. And you can roll over your traditional IRA into a Roth no matter your adjusted gross income. So, like I said, it's the backdoor into the Roth. So if you're going to roll from a traditional IRA into a Roth, and let's say you have $10,000 in your traditional IRA, and all of this is earnings and pre-tax contributions, so tax-deductible contributions, so pre-tax dollars. So none of this has been taxed. You have a zero cost basis. You decide to roll it into a Roth IRA. This is going to be 100% taxable as ordinary income in the year of the rollover. 100% taxable as ordinary income in the year of the rollover. But anyone can roll it over.